All right, our next presentation will be with Intouch.
Thank you. It's great to be at the conference. I see some familiar faces. I see some new faces. We're Intouch Insight. We're traded on the TSX-V under INX, on the OTCQX under INXSF. And with that, we'll put up the favorite slide that everyone likes to read, and I'll give you a second to get every word in, and then we'll move on to the more fun stuff. Who are we and what do we do? So we've been around since 1992, actually. We've got acquisitions dating back to 1978. We've been public for over 20 years. And what we do, and the way I explain it to people is I make sure that when you go to a gas station, a convenience store, a grocery store, a hotel, buy a car, whatever you go to do in the world, you have a better experience doing that than you would have had we not been working with the brands that you're going to visit, right? Effectively, that's what we do. I'm gonna put the last slide first and kind of tell you where we're heading. We are announcing a goal to double our business by 2028. We are currently a nice, stable $25 million business. We want to be a $50 million business within the next 3 years. The board of directors has Eric Butel as our chairman, who some of you may know. We have myself, then we have Lee Bennett, David Oliver, and Jennifer Batley rounds out the board of directors. We have a very tight capital structure. We're trading at about 33 cents right now, which is an $8.5 million market cap. We'll get into some of that value equation later. We have less than 26 million shares outstanding. We're about a quarter insider owned, with Eric and I making up the lion's share. And that is, that's the float. It's pretty tight. This won't surprise you given what I told you we do, and we help you when you're out in the world. The people we look after are people in restaurants, grocery stores, convenience stores, automotive, hotels, hospitality, retail. Those are our customer base. Not one thing in one place, but many things in many places where they need to get a brand consistency. So, we have 45 years of experience in doing customer experience and customer related things. We work with the 3 big databases on the planet. It's pretty much on the planet, but they're based out of North America, but they service the world. We're one of only 2 companies that use them all. We've acquired 12 companies over the last 15, 20 years. We have 2 SaaS products that we sell. We have a platform ecosystem. I'll share you a little around how that works. We work with 4 of the top QSR chains and 19 of the top 50 QSR chains. We've got 6 of the top gas convenience and 14 of the top 50, and 1 of the top beverage companies in the world. So the brands that we work with are people you've heard of. We're not dealing with one-offs and two-offs. We do with hundreds and thousands of locations. This is a slide where I'll kind of explain a little bit about the business for those of you that don't know exactly what we do. The top left is mystery shopping and audit services. That makes up the primary portion of our revenue today. What that is going out to all the locations. Take a chain like a Burger King, right? They have 7,000, 8,000 locations in North America that they have to deal with. They're all supposed to be delivering roughly the same experience to their customers, right? Now, you could argue whether that's great or not, or depending on your preferences, but it's supposed to be the same, right, based on the company standards. When we go to a mystery shop, for example, we go and we just have a regular customer experience. We go and we in that case, we go through the drive-thru, let's say, and buy a hamburger and fries. Then we leave and we report back. And that is not the same as asking, would you return? Would you recommend me to a friend? Give me a happy face. What's the scale out of 5? Those are consumer perception data. Those are how consumers feel about the visitor, what they wanted. We actually measure how each individual location executes against the brand standards they are being told to execute against by the brand. In a mystery shop, they don't know we're there. In an overt audit, we may show up on a surprise basis and do an audit where they know we're doing things. Lets us check more deeper things like temperatures where you can't. It's hard to check the temperatures if you're a regular customer. So there's different ways we do it. But the distinction there is that brands need to know this information because they marry that data with the customer perception data, right? How do you know? What I always tell people is, how do you know what to do? If all of your consumer data says that your washrooms are dirty, right? And you can't argue that. All of your review data says that, your survey data says that. It's irrefutable. Your washrooms are dirty, your customers are telling you the washrooms are dirty. And then if you go out and tell all your operators to go clean the washrooms and get mad at them and start pounding the hammer down on operations, you might just make your service worse because all you've done is make people who might be trying their best feel bad about the way you're approaching them. And if they're not happy, your customers aren't happy, because that's a stat. Well, guess what? We find out whether or not those locations are following your standards, and if you need to change your standards, and you need to there's some different standards, maybe some capital need to be spent in washrooms. We find out whether that's the situation, or whether you do need to bring the hammer down and fix your operations. So it's very, very important data for them. And then, of course, we do have that survey software as well, where we go and collect that consumer perception information. We also have forms and checklist automation software, which allows our customers to go out and do their own audits and their own checks on how they're doing with their standards, but collect that data in an organized fashion, right, with photos and annotations and follow-ups and alerts and notifications, right? They can do all that through our software. And the beauty of having our own ecosystem, that platform that sits in the middle, is we can take that services data and all of that SaaS data, and it's all in one place for each location. So you can compare regions and districts and locations and the chain in one place, doing a whole bunch of analytics and insights from that. With the AI revolution that we're currently all witnessing in the world right now, right, we can provide much deeper insights and analytics now if we have all that information in one place. And that's what we're focused on and working towards. And so and we're the only company that has all of that in one place. Most of our competitors are either software or services in the customer space. And on the ClearPoint solution side, that's merchandising. For anyone who's followed us for more than the last 6 months, knows that we bought a company a couple years ago called Ardent, retail services and merchandising. And Ardent was a land grab, let's call it, big revenue. We did millions of dollars out of the gate. It was great from a revenue standpoint. Margins were terrible. The market was very clear that they didn't really care about large revenue if it wasn't making margins. And after we got into that business and we assessed it, we determined that, you know what, we don't see as we grow there being leverage to get the profit and the margins as it gets bigger. So we peeled back. We shut down sort of the Ardent services business. The good news is we bought it 100% on contingent payments, so it wasn't a bad purchase. It was just a failed experiment going into merchandising. Fast forward to this July, we purchased ClearPoint Solutions, and ClearPoint is our entry into merchandising now. It's a more measured approach. It's taking the same approach we have with the rest of our services. We're going to be doing some slower growth. It's going to be profitable, and it'll scale and get leverage as it gets bigger. And that's what we need to see as we go forward. You will see revenues in merchandising in Q3 when we release. There'll be revenues ongoing, and we expect it to start contributing in a more meaningful way in 2026. And ClearPoint, again, people ask me, well, why did you buy another merchandising company if the last one you did less than 2 years ago didn't work out, right? Simple. The TAM, total available market for merchandising, is larger than it is for all of our other services. It's a huge market. And it's the same customers. It's grocery stores, it's convenience stores. Those are who buy retail, who buy merchandising, right? It's a stable business, it's a larger TAM, and it's the same customers we have today. So it makes sense to try it, but try it the right way. And we're taking all of our learnings from the first experiment and we're putting it into this one, and we're looking forward to how that one proceeds. Now, I'm going to, this will play when I'm supposed to play when I press play here. Hopefully we can all hear it. Everyone is going to have me say, of course, that we're great and customers love us and they need us, right? I thought it'd be good to have just some customers actually tell you in their words a little bit about us. And hopefully this works with the way they've done the audio here. I don't hear anything. Do you know if it's playing? I'll look at, For those of you on the WebEx, we're trying to play a video right now. Maybe you were hearing it and we weren't, but we're not hearing it in the room right now. The tech guy's gonna take a quick look. If he can't find it, I'll move on. But since I didn't want you guys to have to believe me, I wanted you to hear from a few customers telling you stuff, great things about us instead. We'll just, we'll move on and we'll come back if they think they can get this working. One of the things that we're doing is thought leadership. So we have thought leadership where we go and do our own studies. We collect our own data, we do our own information, we produce articles, we produce studies, we produce industry benchmarking. We do it in partnership with industry magazines in the convenience space, the grocery space, the QSR, like restaurant space, pizza. We have partnerships with magazines with the customers where we want to do business. we do studies, and we're very well respected right now in terms of as an industry leader and thought expert, which for anybody who's has been involved in sales at all in the last 30 years, the world's changed, right? People now do everything through the internet. They do everything through who they know and what they know, and they reach out and they do it through Google. It's no longer, you pick up the phone and you have to try to smoosh the person who's getting the phone to get you through to the decision maker, right? That just doesn't happen anymore. And so this thought leadership has been great for us in terms of getting our name and brand recognition out there in our industries. In fact, it has us on main stages. There's a couple of images there. This year, I spoke at a couple of main stage conferences to industries, both the convenience and the food service industry. My CRO and our VP of Sales and Marketing spoke at a couple of conferences. We've been published in a whole bunch of magazines and linked right back to our website from a lot of publications that you've heard of. Like I think the Washington Post, for example, is probably something familiar to you as a concept. So we've been getting some really good traction from just being thought leaders out there. If you look at the history of the company, I go back to 2014 here because that's when I took this job. It was an $8.5 million business, 100% in the services, right? All mystery shopping, really. A little bit of event marketing automation at the time. We then got into software. We decided we wanted to get into the software side of life. We built a SaaS business. We did our only raise we've ever done in 2017 to support getting into that software business. We had great growth, really good traction. We were doing investor relations. As we went through 2019, we were looking great. Early 2020, I was the most optimistic guy. Our stock was trading in early 2020 at 2.5 times what it is today. And we were heading towards a $25 million business in 2020 because of some acquisitions I hadn't even announced yet at that point. And then, of course, the pandemic hit, right? We weren't Shopify. Shopify pandemic was the best thing that ever happened to them, right? You don't need me going out to restaurants or going out to a convenience store when there's lineups and floor markers standing 6 feet apart, right? You can't see a smile through a mask, and everybody already knew their service sucked, so there's no point in having me tell them. And so we hit a real brick wall with that pandemic, and we focused in and we hunkered down, and we said, all right, we're gonna save our customers, we're gonna save our employees, right? We're gonna save the business, and we did. We did a great job, and I'll show you the financials on that period later. We came through it really well, and we came through it strong. We're now a $25 million business. We are stable. There's profitability available. And so what are we doing as we look forward? We're going to get back to growth. So, and that's what we've announced and what I'm announcing today. We're going to get back to growth. We are going to reinvest in that growth in the short term, and we are going to go after it hard. One of the triggers for that, of course, is we have done opportunistic acquisitions. People always ask me, are you going to grow organically or are you going to grow or from an acquisition standpoint? The answer is the plan is to grow organically. We can grow through our services business, through our software business, through the merchandising entry, but we're also an opportunistic acquirer. And as you can see from the slide, we have been for many years, right? Every now and then we buy something, and we buy it based on it being accretive, being a good deal, being good for shareholders. And obviously, that's always another way that you can get to growth, depending on how the market and how things are shaking out. If you look at the financial history, as I mentioned, we were some great growth, great numbers all the way up through 2019. The only time EBITDA dipped was when we spent the money we raised in order to get into the software business, which, by the way, I have no regrets on, because during that pandemic, thank goodness that I had that software revenue coming in every month, because if you take a look during the pandemic, despite the revenue loss, we remained EBITDA positive, right? And then we had the revenue recovery. And if you run a model on the company, and that's one of our challenges, is we haven't been running any IR until recently. And if you run the model, it just looks like we're inefficient. As we add revenue, we don't add profits or EBITDA, right? And what we've really been doing is we've been reinvesting into that, stabilizing the business, now getting growth. And of course, we'll be down a little bit on total revenue this year because of the exit of the Ardent business, but it doesn't affect the profitability because it didn't really have any. From a share history standpoint, we're pretty stingy with shares. I will say I'm pretty stingy with shares. We've had two major step changes over time. One of them is when we did that raise that I talked about in 2017 to get into software. The other one is after the pandemic, we issued some stock units to employees, people who went without pay or had their pay cut. Every single person when the pandemic hit, I cut their pay. I cut my own 50% during that time period. We were focused on the company. And the people who went through that with us and then stayed with us for a couple of years afterwards, we rewarded them with some stock. And other than those two events, you can see it's a very stable, flat line stock situation for the most part. And that is because particularly current valuations, we're pretty stingy with our stock. We want to make sure that we're in a position where, with only 25 million shares out, a lift for everybody is relatively easy to get. And if you look at that value, you got 25 million in revenue, you got 25 million shares. It's pretty easy math at that point. Even I can do it, right? If you were getting a 1x multiple for a profitable services company, you'd be trading at $1, right? We're trading at 33 cents. So there's definitely some opportunity there. And our SaaS revenues have grown every year, 100% organically. It's a good product that we built. We're growing it. Even in the pandemic, it grew. It tailed off a little bit, growth rate recently, because we've taken the pedal off while we are kind of hunkered down a little bit on our strategy to come out in 2026. I can tell you we're putting the pedal back down in 2026. We're expecting the growth curve to be higher than it is now as we look at these SaaS products going forward, because we think we've cracked a few opportunities there. So from an opportunity standpoint, we look after multi-location businesses that absolutely need us. If I could play you a video, they would tell you that they need us. He's telling me I can try to play it now, so I will go try to play that video. Here, let's do this zoom back and see if I can play that video, so you can. The tech god is saying we can do it. Let's try. Oh.
Working with a company like Intouch Insight gave us the ability to ground ourselves in what the customers are thinking. What do my customers want? How do I make them come back more frequently? How do I drive an ROI? How do I increase my sales and my business? And that's really what they helped us to do throughout this entire process.
The pain point that Intouch solves uniquely well is a very robust and professional approach to large-scale sampling. Intouch has the ability to go out into the field and gather that information about how we should go forward.
Partnering with Intouch Insight was an incredibly powerful decision. It absolutely created an extra layer of value in our business model.
By putting this program in place and the focus around late night, we've seen an overall increase in sales from 3 to 5%, all day growth. If we break out the late night day part, one of my markets has been up over 40% year over year. That is incredibly important to us.
Before Intouch, we had a different mystery shop provider, we had a different audit tool, so you have to go source the information from different areas. Really having all that information in one repository makes it very easiest for access to data and get the information we require.
Intouch made launching all the programs super easy. The training that they provide and the patience that they've given us to go through and learn the processes. I would say flexibility and training are their two strongest suits.
They were extremely professional. They were extremely knowledgeable. They were extremely capable of all the things that we went to them and asked for. They were able to produce and quickly turn around.
My experience working with the Intouch Insight team has been nothing other than 5-star. And Intouch Insight was absolutely one of the best decisions I've made in the last year.
All right, we got to play it. So, and some of the, like the Heritage Group that you see there, that's, he operates hundreds of QSRs with different banners because there's large franchise groups. So I just wanted you to see that because it does speak to, the fact that this is a sticky thing that they need. It's not just a fly-by-night type of operation that they kind of can take it or leave it. That's why our customers mostly came back after the pandemic when they didn't have to, right? So they have an ongoing need for what we sell, right? We have a thing that's wanted, that's needed, that provides value, right? We have a strong team. We have a lot of knowledge, right? We've got thought leadership. We've got proprietary technology. We're working on AI introductions and things right now. We've also proven that we're very, very good at managing things, because we managed through the pandemic, we're financially strong, and we have software and services in one place that people just don't typically have. So we have a lot of potential there to capitalize on. As you look forward, we're going to reinvest all our near-term profits. We are absolutely going to go after growth for the next year. We're prioritizing AI, where we can get leverage, where we can not only improve what we provide, but also improve the costs of how we provide it. And we are launching investor relations. We have Hayden IR. Most of you, if you've read the press release, will know we've signed them on starting this month, and they will be working actively with us now to help promote the Intouch story going forward. And we are going to grow. We are going to become a $150 million business by 2028. And that doesn't mean, by the way, that we'll still have no profits when we're at $40 million and $50 million. We're going to have lots of profits at that point. Right? The business has lots of leverage when we get up there, and the investment level won't be required at the same way. At 25 million, we're going to invest. At 50, we're going to invest, but not proportionately. So there's lots of profits as we move forward, right? And so that's sort of the storyline there. And with that, we've got probably 4 minutes left if you want to ask any questions. Yes?
Can you give an example of your customer, how they pay you? Based on my understanding, they pay you a lump sum plus SaaS monthly fee?
So the question is examples of our customers and how they pay us. Our customers pay us either a monthly rate for software. So if you're buying survey, you're buying check, it's an MRR. It's monthly recurring services revenue every month. If you're buying one of the services that we sell, such as mystery shopping, it's per location, per month. Okay? So it's all done on kind of a recurring basis. And well, it could be per quarter, but it's whatever the cadence is that we're visiting all of their locations, it's a per location per. Examples of customer are people like Petro-Canada, Burger King, we work with Sobeys, in Canada, down in the States, you've got Wawa, there's General Motors, we have a broad base of customers. Next, yes?
On the software side, can you share the churn?
On the software side, our churn is very low. It's probably sitting around 3 to 5%. Over time. And one of the reasons why it's low is that what we've been doing is selling our software to our services clients. That's one of the great leverages that we get because they get the most benefit for it. I mean, look, let's be honest. Are we going to go into an RFP for some billion-dollar company for their customer satisfaction survey up against Qualtrics and Medallia and come out of that looking like, no, right? Those are multi-billion-dollar companies with $250 million marketing budgets. But I have beat both of those companies in an RFP, but I've beat them with customers that are buying my services. So they know who I am, right? And so we have a lot less churn because it's with people who know us and trust us and the data combines.
How do you do marketing? The potential customer you talk to, what percentage become your final customer?
Our close rate? Sales cycles can be long. Sales cycles can range from anywhere from a couple of months to 2 years, depending on the size of the program, the type of customer. So close rates change dramatically as you track those things over a long period of time. But our target close rate is 40%. We're getting closer to that now. We're not quite there. But when we get an opportunity to bid, we do very well.
The merchandising TAM you said is huge. It is. Are there a lot of synergies between that and, let's say, the other survey mystery shopper and stuff? So when someone goes into a store to stack in the soup and whatever, that they can also do some check marks on the rest of the store?
The question is there any economies of scale or between the merchandising and the regular traditional businesses that we run? The answer is yes in 2 ways. One is in the actual customers themselves. So when we have the relationships with the same people and the same companies that buy merchandising services. So that obviously gets us in the door to places where we're not an unknown quantity. And so even though we're fairly new in the merchandising side, we're not new to the company, we're not new to field work, they trust us out of the gate. So there's leverage there. In terms of the actual work itself, there isn't a lot of leverage on the actual tasks. The reason being that merchandise, to do it properly, you have to use W-2 employees. You have to use employees like, they're on the payroll that way. In mystery shopping or the site audits, the only economical way to do it is to use 1099s or independent contractors. And so, and if you mix those two, you get into all kinds of, Fair Labor Standards Act problems potentially. So on the downstream side, they really do run as separate businesses. But there's a huge economies of the actual client acquisition and the benefit to the clients have a great combination. Real quick.
Yeah, I noticed that, take a look at last quarter, June 24, we had a $5.5 million, 5.4, and this year 4.8. What is the main difference? So what is the main reason why the revenue has gone down?
You're talking Q2?
Yeah.
Well, the exit of the Ardent business is the primary reason, with not having any merchandising revenue overlap year over year. Our final revenues for Ardent were in 2024 in Q1 and Q2. And so that's the reason why we're done. Okay, and with that, I see a lovely lady walking over to tell me I'm done. So I'll be out in the hallway if anybody wants to talk some more.